Welcome to mistakes many traders make. As I say, we've all been guilty of some of them, if not all of them, in the past. Now, I'd like to thank ActivTrades, which is our partner on this webinar. I'm really looking forward to it. There's a lot to get through, so if it's a little bit fast, I'm going to apologise. Hopefully you can all see my screen okay. As usual, first of all, we just got to go through our disclaimers. Trading does involve the risk and loss of capital and is not suitable for everyone. Hopefully for you, though, it is. And just be aware of leverage, because you can lose substantially more than that initial investment. Everything that we include in these webinars is just purely for educational purposes. You know, we're not trying to encourage you to trade or invest. That must be your decision. And of course, just carefully consider the risks that are involved, your financial situation, definitely your level of experience. And of course, only risk capital you're prepared, but more importantly, that you can afford to lose. Don't risk everything in trading. And of course, if you've got any doubts whatsoever, then seek advice before you risk your capital. And again, for active trades, so just remember that CFDs are complex. Why do so many people lose money at trading? Part of it is because of lack of experience, part of education, part of understanding what they're actually doing. And everything that we're doing here is just purely for educational purposes. It's not investment research, etc., etc. I mean, you can read all this for yourself, but just be advised that as we mentioned, that trading does involve substantial risks, as I'm sure a lot of you know already. Okay, very briefly about us. So Cymax FinTech, we're a leading edtech company. We provide courses, workshops, masterclasses. Everything is about helping the guys coming through, and the experienced guys as well, to improve or gain the knowledge and skills that they're going to need for the financial markets or crypto or for commodities, for anything really. And of course, from time to time, we do hold in-class courses as well. Thankfully, now COVID's over, we can actually do that. And of course, we are committed to provide the best education and experience that's possible, and reasonably priced, may I add. So there's details there. I'm Chris Tubby. So just again, very briefly, I'm Senior Director of Trading and Education for Cymax FinTech. I was senior trader at the age of 22. I've been a market maker on many exchanges for many different products, including out in Italy for an Italian bank. Now, prop trading, which is what we're all doing. I've been trading all asset classes, and I've been doing that using my own capital for the last 37 years. And to be honest, I didn't start with very much. I've had to build it up over those years. And I also found time to consult to the London Stock Exchange Group. And again, there's my LinkedIn profile below. Okay, so when we look at what's going on in the markets today, what's impacting them? I mean, we're seeing crazy volatility, crazy actions, and they're not always doing what we expect them to do either. So, we've got banks failing, of course. Fortunately, that stopped for the moment. And of course, that's not good for anyone to see that. Medium-sized banks at that. So, okay, not the real big boys. So we weren't getting into that same sort of area as 2008 with the subprime crisis. But, it did bring a lot of concern into the markets. And it's over, but it's not over. There's still a lot of banks that are, and central banks even, that are holding on to all of these treasuries that they purchased over sort of the very low interest rates that we had 2-3 years ago. And of course, that if they hold in them, it's no problem. But if they need to get out of them, then it's going to be expensive. The US debt ceiling is still an issue. I mean, those negotiations are continuing today. It's a bit of horse trading, but hopefully they're going to come to a solution. You know, Yellen's saying that they've only got probably a couple of weeks of money left before they run out to pay the bills, which nobody likes to get to, let alone the US government. You know, she's done what she can. She's probably done a fairly good job to keep going up until this point. You know, it always goes to the 11th hour, and it's happened so many times over the years. I mean, if you look since 2000, it's probably happened, say, 11 times, something like that. The Russia-Ukraine conflict continues. You know, apart from obviously loss of life and the situation there, is the fact that it does impact commodity prices, it impacts inflation, and of course inflation is such a major issue for everybody. Thankfully it's off of its highs, but it's not over yet. And you know, as good as it is getting, it's still not there. And personally, I say a lot of that is coming from corporate greed. You know, a lot of these corporations, for me especially the food giants, are taking advantage of the consumer. And they're, you know, it's sort of, when you look at where prices did get to after Russia invaded Ukraine, those commodity prices have dropped substantially, a lot of them over 20%. And yet we as consumers are still paying top dollar for everything in the supermarkets. Central banks are, well, what can I say? Personally, I think, you know, they've got too much power these days, manipulating markets in the way that they buy all these assets to push prices up and such like. Quantitative easing, for me, I say it's the easy option, not the best option. And of course, now we've been going through this massive tightening cycle. That's probably going to peak towards the end of summer. In some countries sooner, in other countries later. Europe's probably still got a little bit more to go there. But I believe that even when interest rates stop going up, you know, a lot of people are saying, oh, well, then they're going to come down. But personally, I don't think they are. I think you're not going to see interest rates come down until at least the early part of 2024. Recession risks are increasing. And again, you know, to a degree, as I mentioned before, these sort of things do happen from time to time. If the central banks can't control inflation, then by sort of almost causing a recession, they get to the point where by taking the sort of the economy down, crashing demand, it gives them the opportunity to start to rebuild from the basics, which they can do. They've done it several times before. Where they find it difficult is they can't control inflation fully because it's not all demand driven. A lot of it has come from the supply side. Now, China reopening again was an important thing, and you know, it was appreciated to a certain degree by most countries. The only thing I would say with China reopening is everyone expected that big surge to come in of demand straight away. Well, of course, that's not always going to happen because China stockpiles a lot of goods. So it's not until sort of a bit later on, it could be 6 months or even 12 months or more before the real full impact of that opening sort of has that impact on the economies and demand. Now, the other thing when we look at that is the fact that Chinese economy isn't that great. You know, they've only just they've just decided they're going to put another 6 months of stimulus into it. You know, they've got inflation less than 1%. And of course, you know, a lot of other central banks would love to be in that position at the moment. The lack of workers, baby boomers. So, you know, we're seeing this situation where there's less people working. There's been more jobs on offer. I mean, in the US, it almost got to 2 jobs for every 1 person that was unemployed. But over time, I expect to see that balance again. I expect to see there less jobs available, and I expect to see the jobless claims in the US and in general increasing as well. Okay, so mistakes many traders make. So, of course, we all want to become successful traders, but that means avoiding some of the common mistakes that a lot of us make from time to time. And as I say, it doesn't necessarily matter how much experience you've got, they can still sort of impact you. So some of the reasons that I believe that this happens is not understanding trading. It's so easy to open an account. Everyone thinks the moment they open an account, they're a trader. And yet you look at any other career, it doesn't matter what other career you look at, there's at least some training involved. But for some, if you want to go into medicine or something like that, it's years and years of training. Not that I'm saying trading is on a par to that, but hopefully you sort of get where I'm coming from with that. A lot of people don't understand the market psychology, how the markets actually react and act and how they interact. Over trading is very, very frequently a problem. Now, that can be just not having a trading plan. It could be not having an idea of trading, so you're just clicking buttons. You're practically scalping the market or trying to, which is very difficult unless you are a pro trader, of course. Maybe trading too many products even, where you're just trying. Now on a demo, that's great, but in live trading, you've just got to be cautious. It's much better to master them one at a time. A lack of discipline, those stop losses are so important. When you see these markets at the moment, there's that sort of, once they gain some momentum, they just keep going. And of course, so sometimes an early stop is the best stop. If you're going to go to the point where you're going to go for a wider stop, then you've got to cut your size down to compensate. You don't want to be increasing the potential risk and losses there too much. Lack of patience is a massive one for most people. I'm fortunate I've been in industry so long. When I was younger, I had massive lack of patience. I was impatient for almost anything. And trading does that to you sometimes because it's so clear cut. But over time, I've learned that patience is the solution, or one of them for sure. And Warren Buffett's, one of his famous sayings is, the market's a way of transferring from capital from the impatient to the patient, and I totally agree with that. If you're impatient, you jump into trades that you shouldn't jump into, and then you jump out faster as well. Confidence is important. If you have a string of bad trades, then that takes that confidence away, and then you get more nervous, more cautious. If you have a string of winning trades, you get overconfident, and then you just feel invincible. And of course, that's when you have probably one of your worst days, when the market reminds you that they're the boss and not us. And of course, if you don't stick to that trading plan, as if you have one, then pretty much we're getting what we deserve. Now, an important factor also is risk reward. If I'm going to risk X, can I make at least 2 times X? And if the answer's no, then I'm not going to take that trade on. I want to be making at least double what I'm potentially going to lose if I'm wrong. Impulsive trades, you're giving away that edge. You're getting in, you're going from a high probability trade to a low probability trade. And of course, a major one is too eager to trade live. Of course, we all want to trade, we all want to make money, but you've got to do it in the right sequence. And trust me, even sort of putting in a stellar performance on a demo account does not guarantee you the right that you're going to do the same thing in live trading, because it rarely happens. And that is because the moment you start to trade with your money, all of a sudden all those emotions flow through, and that's where the trading psychology comes into it. And again, for many, they're undercapitalized. They're tight, their stops are too tight because they don't have the funds not to have those stops tight. So they get triggered before the market then turns and goes their way. Probably 80% of our trades will go against us before they go for us, if they're going to. So what do we need to do? So setting goals and making a plan. Decide your risk tolerance. Define your entries, your exits, and your stop levels, and that all becomes part of your trading plan. And when it comes to trading, I always say that simple is best. The less moving parts there are, the easier it is to identify something if suddenly it stops working and tweak it. And of course, that is part of trading is being able to adapt to market conditions. Now, you need to consider all the factors as well. You've got to do that analysis of the markets. You've got to do your homework. And sort of focus on specific assets. Don't try and trade everything at once. It takes years, if not decades, of experience to be able to do that properly. And of course, sort of all the data that's coming out as well, understanding that what it's going to do to the markets, all that macro side. You've got to understand that technical analysis is great, and I love technical analysis, but that's to help us with our timing of when to get in and when to get out of the markets and give us that visual aid. When it comes to market movements, they're determined by the data. Economic conditions are going to create that. And of course, you've got to define your own trading style, and all of us have a unique trading journey. And you've got to make those goals. You've got to work them out, but you've got to make them realistic as well. So discipline is key. Once you've created a trading plan, it's vital that you follow it. And of course, that consistency that's created from that trading plan, as long as you've got a solid plan, that is, and a solid strategy, then, that is all going to help you with that consistency. And once you start to get that consistency, it starts to remove some of the emotions from trading. And of course, that is going to help you to increase your chances of success. And of course, you've got to be reasonable with your expectations. Trading is not a get-rich-quick scheme. It certainly isn't. It takes years to really get to those sort of levels. And you've got to appreciate the value of patience, discipline, and creating those consistent gains. And, if you sort of make a little bit every day, that's much better than having one big winning day and lots of small losing days or other big losing days against that, because that's when that sort of emotional roller coaster comes back into play. So, for me, I've always been a steady Eddie. For me, my goal is to make money every day, and that accumulates, and you'd be surprised how fast. And of course, you've got to be positive. You've got to believe in yourself. You've got to believe in everything that you're doing around trading and have that confidence. If you lose it, go back to the basics, start again as if you're new to trading, and then build all of that back up again. And of course, you've got to visualize your goals and what that outcome's going to be. And when it comes to trading, I would say that if you can have a regular income while you're learning, or even while you're trading, that's the best of both worlds. The worst case scenario is you need to make money every day. Because you're going to take on trades that you shouldn't take on. If you want to make money every day, that's different, because then you're going to sit and wait and let the market come to your price, hopefully. And of course, you've got to use strategies that match your trading levels and your skills. And, as much as we're going to say, don't let emotions get in the way of your success and your trading, it's much harder to do than to say. And trust me, we all know that. And you've got to stay informed. You've got to watch the data. You've got to watch for the news. You've got to know when central bankers are speaking. And of course, again, it's going to depend if you're intraday trading, day trading, swing trading, or if you're investing, because, there's different scenarios for each of those. So You know, when we was talking about sort of those stop losses, you know, you've got to know when to cut your losses. And you know, that should be a financial situation, you know, the assessment. It should also be a technical one if you're using technical analysis. You know, you don't want to be losing everything from your account in one trade. And of course, you've got to slice and dice it. So you've got to work out how many trades that you want that capital to be there for. And of course, you know, we're humans, we learn much more from our mistakes than we do from our successes. So, you know, you've got to track those losses. You've got to analyze why you lost money. You know, sometimes it's just bad luck, but we can't always blame luck. And sometimes you've got to adjust your strategies as well, and tweak them, you know, once you get that series of data, because again, that is going to sort of help you. And always stay objective with your analysis. You know, remember the markets, you know, you shouldn't take it personal if you have losses. The market doesn't know you. To be honest, the market doesn't care about any of us. It's just there. And of course, so, you know, when we take those losses, we've just got to brush ourselves off, get back up and look for the next good opportunity, but not a revenge trade. I would also say, you know, emotions are such a key part of trading. You know, whether it's from the discipline side, if you've got that discipline and you can control that discipline, then by doing that, you can cut a lot of the emotions out. But you're not going to cut all of them out. You know, I've been in the markets 50 years and I've still got sort of like Jekyll and Hyde in my head. I've got one side saying take some profits and the other side saying, no, there's more in this trade yet. So, you know, you've got the fear and the greed sort of battling each other in your head. So over trading is definitely something that you want to avoid. You know, just to sort of work out your time frames, and of course your time frames should be relevant to how long you're going to hold your trades for. Now that doesn't mean if you've got a 30-minute chart you've got to be out of your trade in 30 minutes. You might be out of it in 2 or 3 hours, but there's got to be some relationship between them. And you know, don't just enter trades just for the sake of a trade, because 95 out of 100 of those are going to be losers. It's also important, and it does help to stop the over trading, is to take a break now and then, you know, just sort of regain your perspective. And of course, you know, screen time is important, but you're going to need those sort of breaks away from your screen. Even when you're in a position, as long as you've got your stop loss in the market and you're prepared, you can always back off. You can always just say, okay, you know, I don't need to be in front of my screen. Because if you're watching every price change on a chart, or you're just watching every price change that happens, you know, you're just going to wear yourself out. You're going to burn out, because you can't make the market change direction as much as we'd love to. But it's not possible. So trading at the end of the day is great. It can give us that great work-life balance that we're all looking for, but trading isn't everything. Now, risk management. So you've got to have strong risk management. You know, if you're oversensitive to losses, then you know you're going to find it a struggle to survive. If you get to the point where you're having your stop losses too far away, you're going to struggle to survive. You've got to get that happy balance, and it takes time. But remember, always just practice all this on a demo first. Just sort of really hone those trading skills. But as I say, don't expect that to suddenly, you know, whatever you're making on a demo to be the same as what you're going to make live trading from day one, because it rarely happens. But of course, having that strong risk management is going to help you enjoy longevity in your trading. Now, if you've got that discipline, it's also going to provide flexibility. You know, if I might want 2 to 1 as a minimum, but there's times when I will accept less. I might only get 1.8, 1.7. But I'll accept that because I know there's other times I'm not just going to get 2, I'm going to get 3 or 5 or 10 times what I expected from the market, especially at the moment because the volatility is there. So, you know, that discipline does provide that flexibility, because when you're locking in those profits, you know, that need to sort of get that certain price is gone. It's, you want that certain price, but you don't need it any longer. And of course, that risk reward ratio is very important, which leads you on to winners versus losers as well. So, you know, they go hand in hand. As I say, 2 to 1. If you go 1 to 1 and you're only right 50% of the time, you're just not making any money. Whereas if you've got 2 to 1 and you're only making 50% of the time, you've still got some income coming in. Now, you know, obviously it's different for all of us, and it does depend on our depth of pocket, how much capital we've got in our accounts. You know, I tend to sort of drain mine down every so often because I don't want to suddenly start over trading just because there's more money in my account. That's not the way to do it. I've got a very set process and I stick to that. You know, that is part of my trading plan and my rules. And of course, you know, you've got to work out how many trades you expect to do per day or per week, because you've got to allocate capital to that and then break it down depending on how frequently you're going to trade. So, as I mentioned, with the risk reward ratio, if I'm, you know, the first thing I'm going to do when I'm looking to go into a trade is ask myself, how much am I going to lose if I'm wrong? I would say, how much can I win on this trade? Wrong attitude. Always look at the downside first, you know, plan for the worst and, you know, hope for the best sort of thing. But, you know, just be prepared for it. And of course, you know, once you've calculated that, then it's much easier to sort of break it down and work that out. So you work out how much you could lose first on the trade, where you need to place your stop loss. And then you turn it around and go, okay, right, now I've worked out how much I could lose. How much can I make? And then you look to see where you believe the market can get to. Again, just make sure it's realistic. And then, of course, you know, by dividing the potential profit by the potential loss, that's when we get our risk reward ratio. And as I say, you know, you should really be aiming for 2 to 1 minimum. If you aim for 10 to 1, you're going to become unrealistic. If you're 1 to 1, it makes it too challenging. You've got to be right 7 or 8 out of 10 trades just to sort of make any profit. So 2 to 1, twice as much profit as loss. That will give you an income even if you're only right 50% of the time. Those winners to losers ratios, again, can be tweaked. But, you know, all of this you tweak as you go along with your experience, you know. And again, you want a decent amount of data. You want a month, 3 months, 6 months, or a year's worth of data to analyze. Having 1 day is not really going to give you any answers, is it? Now, you know, as I mentioned, have flexibility with your trading. So, you know, this is so important, this sort of like winners to losers and risk reward ratio. So I just want to put it in front of you here. So, you know, if you've got the number of profitable trades over the number of trades, and, you know, you want to be at least greater than 50% there where possible. Obviously, the closer you can get to 1, the better. But, you know, if you're taking the average gain of every positive trade against the average loss of every negative trade, so, you know, your winners versus losers, that's going to help you to work out what your win-loss ratio is. So you've got your risk reward, you've got your win-loss ratios, and then you can sort of calculate from that how you're doing. And of course, if you're trading more than one product, you've got to do it per product. So, you know, what you don't want to have is sort of, you know, you're trading one contract where you're absolutely nailing it, you're doing so well, and then you're running another one that you're actually losing money on, but because you're still up on the day, you think, oh, that's okay. But it's not. You know, either find something else to replace the one where you're losing, put more into the one where you're winning, or at least really work hard on the one where you're losing to try and improve that. And of course, when you're doing all your calculations, you know, you're doing all your analysis, you know, I mean, we analyze the markets, we should analyze ourselves as well. You know, if you've got that data, keep a trading diary as well. Then you can look back, you know, you can look through your trades, see where you went well, what went wrong. But you can also start to identify when's your good sessions, when are your bad sessions as well. You know, don't stop trading in your bad sessions though, because all it does is just make another one of them bad. You're never going to get rid of that. But you know, there's certain days of the week that are better than other days. Generally, sort of Tuesday to Thursday are the best days. So, you know, another important thing, you know, we talk so much about stop losses. What about when we're actually making money? So, you know, we're on side, we're watching the market go, we're watching our P&L go up and up, which, to be honest, I don't do. I cover my P&L up when I'm having a winning trade. Well, I've got my stop loss in anyway, so I don't really mind for that. But I don't want to see my P&L going up, because then you end up trading the P&L. You're watching that number go up and up and up. You go, oh, if it goes up a little bit more, I'm going to take that. Bang, you get out of that trade, and then of course it keeps going and going. Oh, why did I get out? It's because you're looking at your P&L. So, you know, as long as you've got your stop loss in, as long as you've got your take profit in, quite often I will actually walk away from the screen, or I will cover up, or I'll go and look at something else. I'm not just going to keep that going all the time. Now, you know, what I tend to do, and you know, it's part of the training that I give to my guys as well, is, you know, once you've got that set level, sort of the minimum you'd like to make on a daily basis, when you're above that, then you don't want to be risking all of that. You just want to risk part of that. And then each time you have another winning trade, you can have one more trade. But, you know, just be careful how much you're risking of that. And then the moment you have a losing trade, stop. And then you might find you've made 2, 3, 4 times what you expected on the day. And that's great, because, you know, over a month, 2 of those days will pay for 5 of your bad days, as long as you keep that discipline. You know, remember, set the maximum you're prepared to lose in a day. So you set a downside daily limit, you know, what's the most, or weekly, depending how frequently you're trading. I don't set an upside stop loss of how much I'm going to make, because once I've got the market's money on the day, I want to try and maximize that if I can. But as I say, once I get past a certain level, if I have a losing trade, then that's it, I'm done for the day. That's it, close down, come back tomorrow. Tomorrow's another day. I like to build positions. It does help with timing. So, you know, I'll find my optimum level where I want to get long or short in the market. And then on top of that, I will sort of then be prepared to come a little bit higher up if it's a buy order to start. And then perhaps I'll break my position down into 3 pieces. So, you know, maybe I'm going to buy, say, 30 lots. So I do 10, 10, 10. So I just break it down. Or if I'm sort of active and watching the market, then I'll just piecemeal it. I'll take a little bit at a time. All I'm trying to do is just get the best average that I can. You know, that's a slightly different to just dollar averaging, which is, you know, basically you haven't got any idea where the market's going. So you buy it and then it goes down, so you buy it again. You know, here comes one of those emotions, the hope that, you know, the market turns around and goes back up enough to get you out of trouble. These markets are unforgiving. They're not going to do that at the moment. And of course, nobody likes to take losses. And of course, you know, you can put on trailing stops to help you with that. So, you know, when you're on side, sometimes we've seen that high price, we don't want to take less then. Well, with a trailing stop, it's going to get you out eventually, which is good. because for us it's, oh, we've seen a higher price, here comes human nature, our greed comes in. If it gets back up there, I'll take my profits. It doesn't get up there, it comes down more. You think, oh, why didn't I just take some off then when I thought about it? If it goes back up there, I will. And of course, over time, the market just drops and drops, and eventually you actually end up getting stopped out of what was a winning trade. Or you can always take off bits of it. You know, when you're on side, you've got a reasonable profit, take off 10, 20%. If it goes more in your favor, take off another 10, 20%. If it goes more in your favor, another 10, 20%. At the end of it, you end up with a really nice average. And again, that can lead to you getting much more than that 2-to-1 risk reward. Now, as I say, nobody likes to take a loss, but it's just part and parcel of trading. You know, it's just a business cost, so don't worry about it. The way I rationalize it to myself is, okay, yeah, I'm losing money on that trade, but what I say to myself is, I'm removing my risk, I'm reducing my risk. And by cutting my risk down, by cutting the size of the position down, if not all of it, then I'm reducing the risk. And then that can't hurt my capital anymore. And then, of course, you know, you just wait for the next opportunity, and that's all there is to that. And of course, you've got to be realistic, as I keep saying. You know, set a daily, sort of daily, weekly, monthly target. I hate the word target, but I'm using it. And then sort of, you know, make it realistic, and then, you know, okay, so where do you go from there? And each month, all you really want to see is, okay, I'm going to double it next month. No, don't do that. Just say to yourself, okay, well, you know, I made this month. If I can make more than that next month, that's progress. You know, sometimes you will make 2, 3, 4 times, hopefully, than what you did the previous month. But again, you know, that word target is dangerous because it makes you take risks that you shouldn't. And of course, if you can aim to get to that sort of 60-40, you know, so out of every 10 trades, you have 6 winners and 4 losers, then, you know, that's sort of reasonable. You know, from day one, that might be a big sort of ask, but over time, you could get there. And of course, you know, that winners to losers is going to improve as your experience grows, as long as you've got a solid trading plan and obviously a strategy that goes with it as well. But just remember, you know, lock in those profits sometimes. Don't just look at it and go, oh, wow, look at my P&L, isn't it great? Because it can evaporate very quickly as well. For me, there's 2 types of revenge trading. First one is obviously chasing the losses, which everybody knows about. There's actually a second one that I think, and that is where you take your profits too early. So imagine you've bought it and the market goes up and you get out, and the market goes up more, and you go, oh, I wish I'd stayed in that trade. And then it goes up even more. You go, oh my God. Suddenly now you don't feel as though you've made any money. You feel as though you've actually lost money. And then it goes up that little bit more and you go, nah, this has gone up too far now. Oh, I'm going to sell it. So now you're going short into a bull market, and you've only done it because you sold it too early. And you took your profits too early. And then what you're really hoping for, without knowing it, is for the market to come back to where you first sold it, so you can get out at that level, and you go, oh, wow, didn't I do well? I bought the bottom and I sold the top. In reality, what's going to happen is you've sold into a bull market, you're going to get stopped out on that second trade, and you're going to give back what you made on the first, if not more. So trading plans. You know, it's very rare you're going to find a pro trader that's not familiar with Sun Tzu. You know, he was a very famous and successful Chinese general, but he was also a philosopher. So in war, the victorious strategist only seeks battle after the victory has been won, whereas he who is destined to defeat first fights and afterwards looks for the victory. Really, that's, you know, playing your trade, trade your plan. It's just another way of saying it. Go forth armed without determining strategy, and you will destroy yourself in battle. Again, have that plan in place. And one of Buffett's famous ones, he likes this, is in the midst of chaos, there is also opportunity. So create a trading plan. It should help you to prevent over trading. It should produce consistency as long as you've got, a solid idea of how you want to trade. And, you've got all that and put it together. And it should also reduce losses. Now, the trading plan has to suit your personality and your risk appetite. And as I keep saying, keep your plan as simple as possible. Financial parameters are the first part in a trading plan for me. The second are the trading parameters. And as I said, maintain a trading diary as well of all the trades that you do. So, it's important that we sort of look at our trades and we learn from our mistakes. So when it comes to trading, you've got to stay up with the latest news, the trends and everything. Of course, social media, but just be careful about social media. And then, of course, review your trading and your trading plan from time. Look at your successes, look at your losses, just sort of go through it all. And of course, if you've got that diary, that journal, then you can look at it and you can work out how you can improve. So this is one that I designed for the guys coming through my courses. If you want a copy of it, then just reach out to us at info@cymaxfintech.com. I've got it as an Excel sheet. You can adjust it, tweak it, customize it, however you want to. But it does give you the ability to keep that record of what's going on with your trading and look back at it. As an Excel sheet as well, if you put all the data in it and you're able to, then you can crunch all those numbers very easily at the end of each week, each month, each quarter, each year. Now, if you're already trading or you're planning to trade live, then make sure that you keep your broker's number close at hand and all your account details, anything you're going to need to access your account. Because what happens if you lose access to the market for any reason? Your connection just drops. And then, of course, you need to get through to that broker. You need to check with him, what orders you've still got in the market. Cancel anything you don't need because you haven't got control. If you've got a position, then discuss that with him and sort of guide him on what you want to do. Stop loss, take profit, OCO. If you do one, cancel the other. Find out what was the time of your last trade and also what your current position is to confirm that it's what you think it is. And then finally, check to find out what happened because you don't want to see it happen again. So I'm just going to cover a little bit on technical analysis for you. So, the majority of traders like candlesticks, and I use them for my analysis as well. But something that goes really well with a candlestick, it really complements it, I think, is Heikin-Ashi. It's just another form of a candlestick. And as you can see, so it's the same market data in front of you, but the two charts do look quite different. And the reason for that is the way that the Heikin-Ashi is formed. The Heikin-Ashi is the one at the bottom of the two charts, candlesticks at the top. So when you look at the bottom one, the Heikin-Ashi, it's got much more consistency with its colouring. The top one's got very intermittent green, red candles, but the bottom one, you've got much more consecutive greens or reds. Now, what I'm going to say to you is do not use Heikin-Ashi for support, resistance, trend lines, anything like that. The only way I use Heikin-Ashi is for trend and sentiment. I just look in for when there's a sudden change of color of candles, and then I look for a specific amount in a specific way. And if I get that, then for me, that is a signal that sentiment's changed in the market. And then if I'm in a position, that's going to make me get out. If I haven't got a position, it's probably going to encourage me to get into one. So, hiking actually for me is just about sentiment, what's going on in the market. One of the oldest chart types in the world is point and figure. And, when I'm using this, all I'm looking for are sort of horizontal support and resistance levels. That's all I'm doing with it. When I start to see sort of its peaks at certain levels and the sellers are holding it there, the buyers can't push it through, or if the market's coming off, the sellers can't push it any lower and the buyers are there, and you can start to see those sort of formations that give you an idea of where the market's going to struggle to get through. So again, it's just an idea for you to look at. At the end of the day, you've got to use what's right for you. Now, pivot points is something that most of our traders use, and I train on these. I use these myself on a daily basis. Now, they're great. And if you're not familiar with them, get familiar with them. Again, we do courses on all of this with our technical analysis. We can help you with any part of trading. Now, as you can see, you've got the solid blue line that goes through. That's the pivot point itself. All of this is calculated off of yesterday's data. And then, the first red line above the blue is what we call R1. It's the first resistance level. And then we've got the darker color, sort of browny color, which is R2. And, you can see how many times these markets get up to those levels and then they're rejected and then come off from them. Or come down and then rejected and then go back up again. And you've got you've got about 8 or 9 where that happened. Now, there are times where they will break through. So, it's not a guaranteed winning plan, trust me. There will be times you will get stopped out. But trading is a numbers game. If you can get more winners to losers and you've got control over your risk management, you're still going to come out ahead. Fibonacci is sort of a little bit more of a longer thing because we're tending to use this more on a daily, although you can use it intraday. You need to have established the range, so it's got to have finished the trend. So from A at the low to B to the high, and then it will populate these levels. Now, the red level, the 618, is the key one because that is the golden ratio. So analysts really like that one. If the market comes down to test that, you'll get a lot of support in front of that line. If it breaks through that line to any degree, you're going to see a lot of stop losses come out because that's where those analysts are getting stopped out in the market. The technical traders are going to buy in front, but they're going to get stopped out when it breaks through. I will happily do that because when it breaks through, if it breaks through by enough and it closes below the golden ratio, then I would actually go short on that, expecting it to come back down to retest A. Remember, all of this is just me as a person, just giving you sort of a little bit of my sort of take on all of this. And of course, we get these trend lines and we've got these market and it's sort of rallying up there. Now, for me, if I get long on that bottom trend line, I'm going to hold on to it much longer. If I get short because it's touching that resistance level, I'm going to get out much earlier. And of course, as you can see from that, once it got through that sort of trend line, we've got all those touching tops there. It broke through. It didn't even come back for a retest of that line. It kept going up. Of course, we'll find lots where it did come back. So, now trading psychology, fear, ego, hope, greed, it's all inside our head, but it's very difficult to sort of compartmentalize it, to control it, but you have to. It's going to be about 80% of your trading. Now, if you keep things simple and you don't overcomplicate your strategies, don't add too many indicators or anything like that, 2 or 3 is max in my mind. Just keep it all simple. Focus on your goals. Have that patience. Don't rush into your trades. Don't make those impulsive decisions, because the majority of them will be losers. And take your time to do your research and analyze, prepare yourself for trading. Before you click that button to trade, ask yourself, am I ready to trade today? And if you can't say yes, then just walk away for 10 minutes and then come back. You've got to get yourself in that zone. Because when it comes to trading, timing is everything. Too early, you could get stopped out. Too late, you've missed a move and you're likely to get stopped out as well. Now, influences, be careful. If you're not feeling well, just don't trade. Oh, I'll be all right, I can do this, but you can't. You haven't got the focus that you need. And that is important. Give yourself a couple of days off, come back nice and clear. You probably have one of your best days because you've got your focus back and you're relaxed more. And of course, when you're in front of your screen, forget your personal life. Put it to the side. You've got to focus on what's in front of you. Focus on your goals. Avoid distractions. And do not be influenced by other traders, especially on social media. And always check their background. Make sure that actually they do know what they're talking about. So even me, check me out. I'm happy for you to do that. Now, trading live, again, is one of these dangerous elements. So, you hear that others are making money, so you think, wow, if they can do it, I can do it. And of course, it's possible, but you can't expect to make money from the get-go. And that success on a demo account does not transfer generally into a live account. And of course, be careful, because if you need to make money to cover bills, you're better off saving, taking your time, practicing on a demo until you've got enough money. Now, if you are undercapitalized, wait, save, prepare yourself. The other thing you can do otherwise, if you don't, if you haven't got enough capital, or you've got enough capital, but you don't want to risk it, is consider a trading challenge, and get one of those funded accounts from another company. They start at 25K all the way up to $1 million. So, very conclusion here, very quick one. Even experienced traders make mistakes. I've got to hold my hands up to that as well. Even from time to time, I have made mistakes. But of course, the secret is if you make a mistake, get out of it at the earliest opportunity. And of course, learn from them. Don't repeat them. And of course, focus on those long-term gains by trying to avoid those mistakes. Never stop learning. Trading is an art. It is a science for sure. And the market's constantly changing and evolving, and we have to do that. We have to adapt with them. And of course, that success journey, it is a journey. It's not a destination. And you've got to sort of just take whatever comes your way. But remember that discipline, that patience, and create that consistency in your trading. Now, you've got to manage your risk, got to manage your emotions, and you've got to stay true to your trading plan. So that sort of brings us to the end of it. Just a brief, very quick, sorry about to rush through it. I just wanted to put so much into this for you guys. So, okay, so we provide weekly, weekend, Sunday evening YouTubes, which help prepare you for the week ahead. We do a daily newsletter, global news, my views. We add chart levels, pivot points, etc. on a daily basis. If you need extra help, then we do one-day workshops that can fill in some gaps, or you can find out if trading is for you. We do 1 week courses where we sort of, by the end of that, you'll feel very confident in your ability to turn trading into a career. And an accredited masterclass if you're really serious about trading as your future. Funded accounts, you can see them there if you want to have a look at one as an example. You can contact us at info@cymaxfintech.com. And my email is chris.tubby@cymax-int.com if you have any questions you would like direct straight to me. For ActivTrades, thank you very much for joining us for this. Really appreciate the opportunity. Here's the contact details for them. Obviously, they'd love to hear from you as well. They offer substantial different contracts for you to trade, opportunities. They're a great company.